Good morning. My name is Heidi, and I will be your conference operator today. At this time, I would like to welcome everyone to the 2018 fourth quarter earnings conference call. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question-and-answer session. If you would like to ask a question during this time, simply press star, then the number 1 on your telephone keypad. If you would like to withdraw your question, press the pound key. Thank you. Mr. Shannon Burns, Director of Investor Relations, you may begin your conference.
Good morning, everyone. You can access the slides supporting this call at investor.harleydavidson.com. Click the earnings materials box in the center of the page. Adjacent to that link, you can find our More Roads to Harley-Davidson plan support materials. Our comments will include forward-looking statements that are subject to risks that could cause actual results to be materially different. Those risks include, among others, matters we have noted in our latest earnings release and filings with the SEC. Harley-Davidson disclaims any obligation to update information in this call. Joining me this morning are President and CEO Matt Levatich, CFO John Olin. Matt, let's get started.
Thank you, Shannon, and good morning, everyone. In July, we announced the More Roads to Harley-Davidson plan, an acceleration of our strategy to build the next generation of Harley-Davidson riders, grow motorcycling, and return our business to growth through 2022. During 2018, we met or exceeded all stated plan milestones here. Our execution is on track, and we're energized that we're getting new and different people, riders and non-riders, stand up and take notice of Harley-Davidson. We're equally energized by our current riders who are deeply engaged in the brand and tell us they too are excited at the direction we're headed. It's clear that for riders today and Harley-Davidson riders of tomorrow, groundwork for an exciting future is being built real time. Our plan to step up our strategic efforts was reinforced throughout 2018 as the industry in the U.S. and certain developed international markets continued to be challenging. While most of 2018 played out largely as we expected, the declining industry performance in the fourth quarter prompted key business decisions, including pulling back on shipments to drive even lower than planned year-end inventory. We also took further belt-tightening restructuring action in addition to our planned cost savings related to optimizing our U.S. manufacturing footprint. Our efforts to transition U.S. production to our expanded operations in York remain on track, and our 2018 program costs were lower than originally planned. Through our actions and keen focus on working capital, we delivered improved year-over-year earnings and cash from operations, and importantly, we maintained our ability to invest in the future. We dug deeper and found ways to go faster while continuing to deliver strong cash to our shareholders. Each of the 3 growth catalysts: new products, broader access, and stronger dealers. When it comes to new products, our 2019 motorcycles are hands down our best product offering ever, demonstrating clear commitment to the passion and preferences of our current riders. During 2018, we launched new models and debuted new rider confidence, safety, performance, and infotainment. Our commitment to lead in the electrification of motorcycling is also clear. In November, our first electric Harley-Davidson stole the show when it made its European debut at the Milan Motorcycle Show. Already this year, we provided a first glimpse of our broader electric portfolio at CES, which drove 2.6 million video views across social channels, with the largest audience being 25 to 34-year-olds. Our statement at CES garnered over 4,500 media mentions on Harley's innovation, technological advancement, and bold leadership stance. Even before the first live wire is delivered, we are reaping the strategic value of this extraordinary motorcycle. The buzz is helping build interest and relevance in Harley-Davidson amongst a new audience and redefining the global perception of our brand. As the halo product in our future portfolio of electric products, Livewire is already doing what it's intended to do. Its value to our brand is captivating and inspiring new people about what's possible with Harley-Davidson and why riding is worth a look. The positioning and pricing reflects the quality, capability, and value of this incredible motorcycle. It's a serious, high-performance, and highly innovative motorcycle, a thoroughbred, the most thrilling motorcycle I've ever ridden. LiveWire is not only igniting passions at the highest echelon of motorcyclists, it's captivating a vast audience who will be inspired to imagine and discover what is possible with Harley Davidson. And that is invaluable. That's what a halo is all about. When it comes to broader access, we're accelerating our progress to grow reach and relevance. This growth catalyst is all about helping us cast a much wider net than we do today. By aligning our efforts in an integrated way, we can attract new and different consumers, increase the value for these consumers, and meet people where they are and how they want to engage. By example, in line with our plans to reach more urban dwellers, especially in Asia, 23 branded Harley-Davidson apparel stores were opened in 2018. These stores in heavy foot traffic areas offer a unique line of branded apparel, which we know is one of the first and easiest ways to try us on and begin their journey with us. In fact, our sample survey tells us over 75% of shoppers say it's their first visit to any Harley-Davidson store, and over 60% are under 34 years old. In 2018, we also launched e-commerce in China via Tmall, one of the largest e-commerce platforms in the world. We see tremendous long-term opportunity in China and will continue to invest in proven activities that drive awareness, interest, and sales. In the U.S., we expanded our reach in a big way with the launch of a Harley-Davidson branded storefront on Amazon.com. Sales were strong, and initial data indicates that the majority of people purchasing our products on Amazon are new to the brand. We also enhanced our e-commerce store on HOG.com and exceeded our milestone for the year with 6% of general merchandise sales through HOG.com in 2018. Full-year total e-commerce sales were up 32%. With these efforts, we're building an integrated multi-channel retail experience that today's consumers expect and providing new consumers an inspiring and convenient way to connect with and shop for Harley-Davidson products. In an environment of rapidly increasing customer expectations, which we're meeting with an expanded portfolio of products and services, the motor company and our dealers must be prepared. Dealers are a critical component of our success as they bring the spirit of Harley-Davidson motorcycling to life each and every day. That's why Stronger Dealers is one of our growth catalysts. It emphasizes dealer capabilities and puts in place increased support and incentives under a performance framework. Part of this work includes creating conditions for growth through consolidation, scale, and investment for every willing. Strong Dealers means optimizing our network composition, providing more meaningful support tailored to individual dealers' needs, and expanding our international footprint. In 2018, 56 international dealerships were opened. Underpinning all our efforts globally is the top-line strategy to build the next generation of Harley-Davidson riders through 2027. We set 10-year objectives knowing this would be a long march, change the way people think about motorcycling. It requires our very best efforts, significant change, and it requires time. More Roads is our plan to accelerate our progress, and it includes clear deliverables in 2022. Our capabilities in building and retaining new riders are improving. We continued the momentum we started in 2017 and ended 2018 with over 52,000 more Harley-Davidson riders in the United States. All positive signs, but more is needed. Our marketing investments engage new and existing riders in 2018. Riding Academy sales conversion was up 2.2 percentage points over last year. We drove relevance and interest through our activations with celebrities and social media influencers, whose content and activity generated equivalent traditional media value that was up for 80%. Thousands of Sportster and Street purchasers were offered the Freedom Promise, an incentive to trade up to a new motorcycle, and existing riders demonstrated their increased engagement by logging 45 million miles to our Ride 365 app, a 137% increase over last year. Nothing sells riding like riding, and keeping existing riders engaged is key to growing our business. Looking forward, our efforts will intensify. We're on track with our new middleweight motorcycles planned to launch in 2020. The Pan America Adventure Touring and Street Fighter motorcycles are being put through the paces on all kinds of terrain and are demonstrating power, strength, and competitiveness. The immense talent and capabilities of our design and engineering team continue to boldly expand how the look, sound, and feel of Harley-Davidson motorcycles drive appeal with new types of people. Focusing now on 2019, we know market challenges will persist, and we're meeting them head-on with drive, clarity of purpose, and a solid plan. Our More Roads plan leverages our many strengths, and it is our call to action as industry leaders. In the U.S., it commands us to increase the relevance of and participation in motorcycling. Our plan recognizes and addresses changing global consumer preferences toward more accessible motorcycles and a growing interest and demand for ease, power, and thrill of electric. And More Roads recognizes the tremendous international opportunities that we believe will drive international sales to become at least 50% of our annual sales volume in the not-so-distant future. We'll continue to lead with passion and focus to disrupt the status quo and ignite a cultural movement for motorcycling, inspiring new people and our current riders to join us all along the way. Thank you for continuing to ride with us well. And now I'll turn it over to John to discuss the financial results of the quarter and the full year. John?
Thanks, Matt. Our fourth quarter financial results were impacted by, first, our decision to reduce shipments in an effort to lower worldwide retail inventories, as well as a result of slightly lower than expected retail sales in our international markets. Next, we booked 2 voluntary recalls during the quarter, and finally, we recorded an additional restructuring charge in our efforts to aggressively manage the company's costs. In the face of ongoing retail sales headwinds in the U.S., we remain focused and disciplined on tightening U.S. retail inventory, aggressively managing costs, and driving improved cash from operations. In fact, in 2018, we increased operating cash by over $200 million, a 20% increase over prior year. Summary of our Q4 results is on slide 10. In the fourth quarter, revenue was down behind lower shipments. Motorcycle operating income was impacted by lower shipments, $19.4 million of restructuring charges, higher year-over-year SG&A driven by 2 recalls, and the impact of incremental tariffs. Financial services operating income was down slightly. Consolidated net income was largely flat to prior year due to lower operating income, offset by the benefit of considerably lower taxes. EPS for the quarter was 0 cents per share. When excluding restructuring plan costs and the impact of incremental tariffs, EPS was 17 cents per share. We remain focused on delivering strong margins and returns over the long term. On slide 11, worldwide retail sales of new Harley-Davidson motorcycles in Q4 were down 6.7% versus prior year. In the U.S., Q4 retail sales were down versus prior year, driven by significant declines in the U.S. industry and slight market share declines. International retail sales were down modestly in Q4, driven by year-over-year declines in certain developed markets, partially offset by continued growth in emerging markets. While we expect our business to remain under pressure in 2019, driven by continuing challenges in the U.S. motorcycle industry, we intend to introduce exciting new products and add innovation that customers value on our new motorcycles. We also expect to aggressively manage supply and execute marketing efforts to encourage trial and increase conversion to sale. Through 2022, our More Roads to Harley-Davidson plan is designed to build the proper foundation, drive the right fundamentals to help steer the U.S. industry back to health, and to drive significant growth across our international markets. Let's take a closer look at the U.S. on slide 12. Retail sales were down 10.1% versus prior year quarter. While the U.S. retail sales decline is very disappointing, decline was in line with our expectations. The U.S. industry was down 8.4% in the quarter. We believe the industry was down largely because of soft used bike prices and a relative shift in rider preferences towards smaller motorcycles. Looking at used bikes, prices remain at historically low levels compared to new. However, we are encouraged as we continue to see positive momentum in used bike pricing. During Q4, pricing services such as NADA and Black Book published higher values for Harley-Davidson motorcycles, while prices were slightly lower at auction. Additionally, the 6th consecutive quarter saw rising prices of used Harley-Davidson bikes in our dealer network. Used Harley-Davidson motorcycle sales were up through November. Our share of the combined new and used motorcycle registrations was up through November and has been for the last 9 consecutive years. We believe used sales are also an indicator of our brand health and provide prospects for future new bike sales. 2018 full-year market share of new bike registrations was 49.7%, down 1.0 percentage points. Our U.S. market share reflects the adverse impact of a highly competitive marketplace and relatively strong growth in segments which we do not currently compete. In the segments where we do not compete, touring and cruiser segments, which represent approximately 70% of the 601 plus cc market, our market share was up 0.8 percentage points on a full-year basis. During the quarter, we pulled back on shipments of new bikes in the channel. This resulted in year-end U.S. retail inventory decreasing approximately 350 motorcycles over the prior year. We believe this market discipline is important in maintaining customer and dealer value and will ultimately result in stronger retail sales of new motorcycles. On slide 13, international retail sales were down 2.6% in the fourth quarter, slightly below our expectations. On a full-year basis, international sales were up slightly. During Q4, emerging market retail sales were up 18.7%, driven by double-digit growth in several markets, including China, Brazil, and India. Retail sales in developed international markets were down in the fourth quarter, resulting primarily from ongoing weakness in Japan and Australia. During 2018, these two markets experienced contracting industry sales and competitive new product introductions in segments outside of our touring and cruising. Retail sales were also down modestly in Western Europe, driven by weak consumer confidence in France and the UK. On a full-year our full-year market share in Europe was 10.3%, up 0.5 percentage points versus the prior year. As the detail on our More Roads plan reinforces, we remain confident in, committed to, great potential that international markets offer to Harley Davidson. We believe our brand, products, and distribution will drive sustainable growth in international markets. On slide 14, wholesale motorcycle shipments were down in the quarter and on a full-year basis. We came in under our full-year shipment guidance as a result of our decision to reduce retail inventory from planned levels in both the U.S. and international markets on a lower-than-expected international retail sales. Compared to last year's fourth quarter, Street Sportster shipments as a percent of the total were up behind an improved sales rate, offset by lower cruiser mix as we lap last year's initial sell-in of our new Softail motorcycle. On slide 15, revenue for the motorcycle segment was down 8.7% in the fourth quarter, behind a 7.9% decrease in year-over-year motorcycle shipments. Revenue during the quarter benefited from a $230 increase in the average motorcycle revenue per bike. This increase was driven by higher year-over-year pricing and favorable mix, partially offset by unfavorable foreign currency exchange. Both P&A and general merchandise sales lagged retail motorcycle sales growth in the fourth quarter, due in large part to the timing of our fiscal calendar that had one less week versus last year's calendar. In addition, general merchandise was down as it lapped strong sell-in of our 115th anniversary products. Full-year revenue was up 1.1%, despite shipments being down 5.3%. We believe this demonstrates the resilience of our company and brand in the face of. On slide 16, gross margin in Q4 was down as a result of lower shipments, unfavorable manufacturing expense, and higher raw material costs, partially offset by higher pricing and favorable currency. Financial impact of currency was favorable by $4.0 million during the fourth quarter. Q4 foreign currency exchange gains were partially offset by a stronger U.S. dollar, which adversely impacted revenue by 1.5%. Raw material costs were higher during the quarter behind increased steel and aluminum prices. Finally, manufacturing was unfavorable versus prior year, driven by the impact of incremental tariffs, lower absorption on reduced production and shipments, and temporary inefficiencies related to our manufacturing optimization. Q4 tariff costs increased by $13.4 million, driven by higher EU and China tariffs. The full-year impact of incremental tariffs, $23.7 million. On slide 17, operating margin as a percent of revenue for Q4 was lower compared to last year, driven by lower gross margin, higher SG&A, and restructuring expense. SG&A was adversely impacted by 2 voluntary recalls booked in the fourth quarter. The first was the $35 million clutch recall on certain touring and softail bikes, which we discussed last quarter. The second was a brake recall on our street motorcycles, for which we recorded a $20 million charge. We believe that limited parts availability for repairing our street motorcycles will adversely impact our Q1 2019 retail sales by approximately 2,500 motorcycles, primarily in our international market. We do not believe that these recalls will have a meaningful impact on our full-year retail sales. Restructuring charges totaled $19.4 million in the fourth quarter, including ongoing manufacturing optimization of $15.5 million and an additional $3.9 million restructuring charge related to cost reduction efforts. Profitability and strong cash flow remain a key focus. It is our objective to further leverage our established capabilities to drive profit, cash flow, top quartile ROIC into the future. Financial Services Q4 operating income, shown on slide 18, was slightly lower compared to prior year. Net interest income was up $4.4 million due to higher year-over-year receivables. In Q4, there was a reporting change in which Harley Davidson Dealer Systems business moved from the motorcycle segment to the Financial Services segment. Harley Davidson Dealer Systems provides dealer management system software and services to the majority of our U.S. dealers. Under the leadership of HDFS, this business will leverage HDFS's key competencies related to managing dealer-facing systems and servicing the U.S. dealer network. During 2019, we expect this reporting change will increase both financial services revenue and operating expense by between $10 to $13 million, while having only a modest impact on operating income. HDFS's operational results are on slide 19. Q4 originations were up 8.0% versus prior year, driven by increased used motorcycle sales in the dealer network and a higher HDFS market share of new motorcycle sales. Market share was 69.5%, up a very strong 9.6 percentage points during the quarter, driven by competitive U.S. retail sales rates and HDFS's continued commitment to full credit from lending. At the quarter's end, there was $609.2 million of cash equivalents at HDFS, and $1.0 billion of liquidity available through bank credit and conduit facilities. During 2018, HDFS paid dividends of $235 million to Harley Davidson. On slide 20, 30-day delinquency rate for retail motorcycle loan receivables on our year-end balance sheet was 4.12%, or 9 basis points lower than Q4 2017. The annual retail credit loss rate for receivables on our balance sheet was 1.76%, or 14 basis points lower than 2017. HDFS continues to maintain a robust liquidity position, contributed strong profitability to the company. The remaining Harley-Davidson, Inc. financial results are summarized on slide 21. Our year-end cash and marketable securities balance was $526.3 million over prior year in anticipation of paying off a $600 million MTN matured on January 15th. Year-to-date operating cash flow was up over $200 million, or 20% from last year, driven by lower working capital as we remain very focused and diligent on our use of operating cash. Our effective tax rate was 22.6% in 2018. It was considerably lower than last year, driven due to the impact of the Tax Cuts and Jobs Act. In addition, fourth quarter of 2018 benefited from lapping last year's write-down of $53 million of deferred tax assets related to the 2017 Act. And finally, regarding liquidity, the company has and intends to continue to maintain a minimum of 12 months of projected liquidity needs in cash and or committed credit facilities. Harley-Davidson's full-year financial results are summarized on slide 22. Revenue, net income, earnings per share were all up in 2018 despite lower shipments. $106.3 million in charges related to our restructuring plan costs, $23.7 million due to the impact of an increased SG&A and higher recall costs. EPS for the year was $3.19, and when excluding restructuring plan costs, the impact of incremental tariffs, EPS was $3.78. We believe the charts on slide 23 demonstrate that we benchmark very well against various peer groups in our ability to generate and return cash to holders for the period of 2015 to 2017. One of the 5 objectives guiding our business strategy and execution through 2027 is to deliver superior return on invested capital measured by motor company ROIC being in the top quartile of the S&P 500 and by a best-in-class return on equity at HDFS. Harley Davidson is a leader in ROIC at the motor company and ROE at HDFS is a clear leader in our ability to generate and return cash to our shareholders. Slide 24 illustrates our recent history of returning cash to shareholders. In the fourth quarter of 2018, we paid a quarterly dividend of 37 cents per share, repurchased $194.2 million of our stock. Driving superior value for stakeholders is a top priority. After investing in our business, we intend to return excess cash to our shareholders in the form of increasing dividends and share repurchase. Slide 25 is a summary of our multi-year manufacturing optimization initiative. We now expect total program cost to be between $152 to $162 million versus our most recent estimate of $155 to $185 million. We are also lowering our capital estimate to $65 million versus our most recent estimate of $75 million. We continue to expect our manufacturing optimization to yield ongoing cash savings of $65 to $75 million. In Q1, we expect manufacturing optimization costs of approximately $20 million. We believe these investments have very attractive returns. When completed, we expect this initiative will simplify our manufacturing footprint, provide focus in our operational investments, and improve gross margin by roughly 1.25 percentage points. Moving on to 2019 guidance on slide 26. We expect the declines in the U.S. industry to continue into 2019, albeit at a more tempered pace than in 2018, and we expect international sales growth. As a result, in 2019, we expect to ship between 217,000 to 222,000 motorcycles, which is down approximately 3 to 5% versus prior year. During 2019, we expect retail sales to be positively impacted by focused investment in our strategy to increase global ridership, model year 2019 and 2020 motorcycles, and continued expansion of our international dealer network. However, we expect these positives to be more than offset by strong headwinds, including the weak U.S. new bike industry, a relative shift in U.S. rider preference towards smaller motorcycles, and a marketplace crowded with highly competitive promotions, incentives, and discounts. In 2019, we will continue to aggressively manage supply in line with demand and plan for U.S. year-end inventory to be down versus 2018. We expect gross margin as a percent of revenue to be lower than prior year, driven by a significant increase in incremental tariffs, lower volumes, and unfavorable mix, partially offset by aggressive cost reductions, including the benefit of $25 to $30 million of manufacturing optimization savings. During 2019, we expect incremental tariff costs to be approximately $100 to $120 million. These costs include EU, China tariffs on our products shipped from the U.S., as well as U.S. tariffs on certain items coming from international markets. This estimate excludes metals costs resulting from U.S. steel and aluminum tariffs, but we do expect higher metals costs that are included in our gross margin guidance. We intend to mitigate the impact of incremental EU and China tariffs by year-end. Our plant in Thailand came online in Q3 2018. As we explained when we announced this project in 2017, we intend to utilize it to make more of our products accessible to customers in targeted international markets, including our China and ASEAN markets. As our operations in Thailand ramp up, we expect to realize manufacturing efficiencies and to lower our cost of motorcycles produced there to serve other international markets. Looking at SG&A, We expect SG&A to be lower in 2019 behind aggressive cost management and lapping 2018 recall costs. For 2019, we have reallocated a substantial amount of our SG&A spending to invest in our More Roads plan to drive future growth. For 2019, the motorcycle segment operating income is expected to be between 8.0% and 9.0%. Excluding the impact of incremental tariffs and manufacturing optimization costs, we expect operating margin as a percent of revenue to be largely flat to 2018. We are very focused on improving operating margin. In line with our plans, we expect motorcycle segment operating income in 2020 to improve by approximately $170 to $200 million versus 2019 as we complete our manufacturing optimization and continue to address tariff impacts on our business. We expect financial services operating income in 2019 to be down compared to 2018, driven by a higher cost of debt and higher depreciation on our investment in a new loan management system which went live on January 1st. Capital expenditures in 2019 are expected to be between $225 and $245 million, which includes approximately $20 million to support manufacturing optimization. We expect our full-year effective tax rate will be approximately 24-25%. As we look forward to the first quarter, we expect to ship 53,000 to 58,000 motorcycles, which is down approximately 9 to 17%. Segment operating margin as a percent of revenue is expected to be down approximately 6 percentage points from Q1 2018. We expect first quarter will be adversely affected by incremental tariffs, unfavorable mix, lost absorption on lower shipments, and unfavorable currency, partially offset by lower year-over-year restructuring costs. Despite the challenges we faced in 2018, Harley-Davidson's demonstrated its incredible resilience by growing revenue and profits, delivering significant higher year-over-year operating cash, and returning $628 million to our shareholders through dividends and share repurchase. As we look beyond 2018, we are prepared for an extremely dynamic and highly competitive global motorcycle market. We will continue to focus our investments, deliver strong returns to our shareholders, and drive growth for the company over the long term. Thank you. And now let's take your questions.
In order to ask a question, please press star, then 1 on your telephone keypad to be placed into the queue. We ask that you limit yourself to 1 question. If you have further questions, please press star 1 again to re-enter the queue. And your first question comes from the line of Sharon Zackfia with William Blair. Please go ahead.
Hi, good morning. I guess a question on the used bike pricing. So I think you've been talking at least fairly consistently throughout 2018 about the bike pricing improving in your dealer network and some other auction sources that you get, but it hasn't really manifested itself seemingly in any improvement in retail sales. So, as you've looked at this historically, what kind of lag is there normally? I mean, when would you expect to see those used bike prices start to, narrow the gap so that the trade-off into used is less attractive to the consumer than it seems to be today?
Thanks, Sharon. This is John. Sharon, coming out of the fourth quarter of 2014, we saw a precipitous drop in used bike prices for about 13 consecutive quarters, and we have seen improvement for the last 6. But the level which it fell for those first 13 quarters is much more than we've seen in the improvement in the last several quarters. We still have a sizable gap, and the gap between new and used is at historical levels. We expect first to see the stabilization. We've got stabilization in used bike prices. Next, we would expect to see stabilization in the industry, new motorcycle sales. And as we look forward to 2019, we do expect them to improve. Part of the reason being is behind a more stable price gap between new and used. But having said that, the gap is still wide, and we still would expect the overall industry to be down.
And I'll just add, Sharon, this goes back again to the focus on building new riders, right? Creating more riders, demand on the side of the total supply side. So growing 50,000 additional Harley riders in 2018 is building momentum for 2017, and obviously continue to invest even more behind that as we roll forward, and that should help dynamic.
Okay, thank you.
And your next question comes from the line of Felicia Hendricks with Barclays. Please go ahead.
Hi, good morning. Just one thing, I know you've had this issue in other quarters. When you guys have been talking, you've been kind of drifting in and out, so some things have been hard to hear, so just a FYI. John, can you just talk for a moment about your outlook for 2019 shipments and the cadence? It seems like your first quarter definitely is factoring in the challenges that you're seeing and that you've discussed on the call. And then when we look forward, at the second through fourth quarters, that implies a flattish growth in shipments. So maybe first you could help us just understand how you're thinking about the cadence throughout the year. Would maybe second quarter be down and then the second half be up, something like that. And then, just why are you confident in your overall outlook given the challenges at retail and the industry, both internationally and domestic? And it seems like some of the international pressures are relatively new. Thanks.
Thanks, Felicia. As we look to let's start with the first quarter. As we look to the first quarter, we expect shipments to be down 7 to 19%. And you're absolutely right, Felicia, that a portion of that is the fact that we will not be shipping. We do not expect to ship street motorcycles in the first quarter. That represents about 4.5% of that total. In addition, we expect coming out of the first quarter with lower inventories in the U.S., so we're going to continue to keep overall inventories very tight as we move into the selling season. What we would expect from there is to see shipments really track well with retail sales. And throughout the year, we would expect retail sales to improve as we invest in stronger dealers, which is part of our More Road strategy. In fact, when we look at 2019, overall, we will have a significant investment in More Roads in the neighborhood of $100 million. So to get to the final part of your question, Felicia, is why do we have confidence in the shipment guidance that we've given? That is a big part of it. We are investing heavily in More Roads and stronger dealers, and certainly the new products and broader access. And as Matt had just mentioned, we came off of 2018 creating 52,000 new riders to Harley Davidson that weren't there a year ago. We're gaining momentum from 17 to 18, and we expect that momentum to increase and continue into 2019.
So just as far as the cadence goes, can you give some color there? And can you help us understand how many dealers you're adding internationally this year?
Yeah. From a standpoint of the cadence, I can't provide a lot more. You've got the first quarter, and we will see it improve throughout the year. In terms of international dealers, we expect to add 25 to 35 more dealers in international markets in 2019.
Okay. Thank you.
And your next question comes from the line of David Becker with Bernstein Research. Please go ahead.
Hi, good morning. Just had a question about the 52,000 new riders that you added this year. Can you provide us some color on maybe demographic aspects of these new riders, how they differ from your existing base, and to what extent are they buying new versus used? Anything along those lines would be helpful.
Thanks, David. This is Matt. As I hope we've adequately described in the past, rider migration knowledge base, the combination of several data, then we don't get. Actually, it was last Tuesday, and it begins the analysis. So all we have right now is that top level site. Obviously, we have all we need to get at the question you're asking, and that's what drives the nature of our work and the focus on high leverage pools of potential customers, and underpins what John talked about, confidence, guidance we have for sales. So it's work that the teams are doing right now. We're obviously very interested and eager insights that we don't have now to share.
Got it. Thanks. And just one quick follow-up, if I could. By what amount do you expect inventories to be down at the end of the year? I think you mentioned you expected that.
Yes, this is John. We're not providing an exact amount. We expect overall U.S. shipments to be down and consequently, inventory will follow.
Great. Thanks.
And your next question comes from the line of James Hardiman with Wedbush Securities. Please go ahead.
Hi, good morning. Thanks for taking my call. I just wanted to follow up on that last point. I mean, on inventories, obviously, 350 bikes in terms of a domestic decline is a start, but it kind of feels like a drop in the bucket versus 17,000 bikes that retail was down in 2018. So I guess my question, John, you don't need to give us actual numbers, but it's pretty clear that inventory turns worsened materially in 2018. Is the goal to get back to the inventory turn number that you had coming into 2018, just given how much that appears to have changed based on the numbers that you've given us?
Thanks, James. I probably wouldn't agree completely with your overall assessment, but you're absolutely right. In the fourth quarter, 350 was not enough to hold year-end turns. But when you look across the entire year, actually over the last, we have reduced inventories in each of the 4 quarters anywhere between 10 and 35%. And our guidance all year long has been for flat. We came in a little bit below that. And at this point, we couldn't feel more comfortable with where our inventories are. Certainly, our dealers echo that, and all the surveys that are run, it's 80+% that feel comfortable or that they have too little inventory. So we have absolutely no issues with where we're at with regards to inventory, and the mix considerably better than last year. Again, as I mentioned to Felicia, we'll continue pressure on overall inventories, and we'll take inventories down in the first quarter in the United States. But we feel very comfortable where we're at. To answer your final question, we'd be looking to hold turns.
I'm sorry, you broke up there. Your aim is to hold turns?
In 2019, would be to hold turns. Constant.
Versus 2018 or versus 2017?
No, versus 2018. 2019, we'll look to hold turns to 2018.
Right, but the 2018 turns were a lot worse than 2017, right? I mean,
just went through that. There are 4 quarters of the year. The turns were better in the 3 of the 4 quarters. In the fourth quarter, and we talked about this as well, push back our surge manufacturing, provides a lot of efficiencies and cost reductions in our plants out of December into January. Right now, we feel very comfortable where inventories are. Our dealers certainly feel the same. They feel pressure that they're too little. And we'll continue to manage turns at this rate as we go forward. And that's it.
I apologize. You're cutting in and out, John, but it sounds like you're saying that inventory turns didn't get worse in 2018. I mean, I think about 350 bikes. That's maybe a 1% decline versus the 10% retail decline. Am I not thinking about that the right way?
No. James, I told you that in the fourth quarter, turns got worse. In the other 3 quarters, they got better. We sell product throughout the 4 quarters of the year. We have kept turns. Turns got a little bit worse in the fourth quarter, and consequently on a full-year basis because of manufacturing. We pushed back our surge manufacturing to gain additional efficiencies, and we feel very comfortable where year-end inventories are this year. Next year, we will reduce inventories in the United States because we expect shipments to also reduce because of a weak U.S. industry, thereby holding turns on a year-over-year basis from 2019 to 2018.
Okay. Thank you.
And your next question comes from the line of Craig Kennison with Baird. Please go ahead.
Good morning. Thanks for taking my question. It's on Thailand. Can you shed more light on the timing of additional capacity in Thailand? What do you think your eventual capacity will be from a unit perspective? How long is that going to take to ramp up? And then just remind us which markets you plan to serve from that facility.
Thanks, Craig. Craig, we're currently investing in expanding the capacity of our Thailand facility, and we expect to be producing the majority of our motorcycles for the EU, China, and ASEAN markets by the end of this year.
Next question.
Your next question comes from the line of Tim Conder with Wells Fargo Securities. Please go ahead.
Thank you. John, I don't know if you cut out there again, but in all honesty, you guys, the call quality here is pretty poor. There's a lot of cutting in and out from the whole call. But did you say expecting to produce the majority of those by year end? Was that your last part of your response to Craig's question?
I'm sorry. Sorry for the poor audio quality. Yes, by the end of this year, we will have the capacity in our Thailand facility to be shipping and the amount of capacity to cover our needs in the EU, China, and ASEAN markets by the end of this year. For that, we expect overall tariff costs to be $100 to $120 million in 2019, and we would expect those to come out in 2020 as we would be producing from our Thailand facility at the end of this year.
Okay. Thank you. So from a cost perspective, is this included within the manufacturing optimization that you all outlined earlier in the call? Those costs are those for the Thai facility. Just wanted to clarify that.
Thanks, Tim. No, they are not included in that. The manufacturing optimization is largely the consolidation of our two final assembly plants in the United States, moving KC to York and exiting a wheel manufacturing plant in Australia. With that, we are well on the path to completing that project, which will be completed later this year and deliver separate savings of $25 to $30 million for this year, and then building up to $65 to $75 million of savings.
Okay, that helps. So within that, then, what is the cost for the Thai investment ramp? What's included in the guidance this year related to the Thailand plant? Again, expansion and the ramping related costs.
Right. So the Thailand plan, again, was something that we announced back in 2017, and the plant was completed and came online in the third quarter of last year, of 2018, and that was the bulk of the spending on that plant. Given the fact that we're now looking to supply additional markets from Thailand, we are expanding that plant, and that's a cost increase in both operating expense as well as capital. The capital investment in 2019 is about $15 million.
And from a ramping cost, inefficiency cost, however you want to frame it, any color there, John?
It will be a higher cost. I don't have that number in front of me, but it is a manageable cost by the company.
Okay, great. Thank you.
And your next question comes from the line of Jamie Katz with Morningstar. Please go ahead.
Hi, good morning. Can you talk a little bit about the financing landscape outside of HDFS? It looks like you guys are taking a larger share of lending domestically, and I'm curious if that's because it's maybe backed off from other originators, or if you guys have seen just a different opportunity set for that part of the business. Thanks.
Thanks, Jamie. We don't see a big change in the competitive set in lending. Remember that most of the people lending on motorcycles are only lending in the top-tier prime segment and not in subprime. But we haven't seen a dramatic change. And the next largest competitor, Harley Davidson, is very small, so I don't think we would really discern a big change. I think what you're seeing it this year, and you've seen it for the last 3 or 4 consecutive years, is HDFS is doing an absolute fantastic job of delivering to our dealers, integrating into their business process, and being very high quality at what they do. And that is garnering the share that you're seeing. We couldn't be more happy. And for that, I'll put a plug in for HDFS. They had a record earnings year, and it was done in an absolutely fantastic way. They grew revenues 2.2%. Despite the fact that new motorcycle sales in the United States were down, and they improved the delinquencies as well as credit losses. So we're very pleased with the business there, including the market share that they've garnered.
Okay. And then can you guys talk a little bit about the 52,000 domestic riders? We're now 2 years into this program to get 2 million new domestic riders by 2027, and obviously the math gets harder. Every year you fall short of 10% or whatever if you want to divide it evenly. So is the implication that the market will stabilize and then get much better, or that the products will just attract that many more customers to help you meet your goal as you think about it longer term? Thank you.
Yeah, this is Matt. When we put the 2 million riders goal out, it was really a stake in the ground to get the attention of the organization and the dealer network about the work we had to do. It was prior to having the insights that we now are able to gain with the rider migration database. We talked a little bit about that earlier. We increased the number of Harley Davidson riders. Ultimately, what we're after and everything that we're doing, the exact math doesn't necessarily correlate to the 2 million, but to put a little bit of perspective on the net 52,000 increase, it came as a result of people entering the sport on Harley, and it came as a result of people exiting the sport. We brought in 278,000 new riders, Harley Davidson cycles in 2018. That exceeded the number of people that exited by 52,000. And so when we look at the task that we have and all of our efforts under More Roads, it's really about two things. It's about bringing in new riders, inspiring them with new kinds of products like what's represented in our full EV portfolio and the middleweight platform. And it's about keeping existing riders participating and riding longer. I mentioned the Ride 365 app, 137 number of riders. So we're focused as an organization on the task to build riders. I think the challenge that we have with connecting 2 million new riders, the insights we now have about rider migration is something that we'll continue to dimensionalize for everybody. But I think the important message is we're making progress increasing the number of Harley riders, and we expect More Roads to accelerate that trend as well as capitalize on the global market for the company.
Thank you.
And your next question comes from the line of Joe Altobello with Raymond James. Please go ahead.
Hey, thanks, guys. Good morning. I guess first question, just a clarification on the Q1 guidance, and I apologize, the call has been going in and out, but I think you guys said operating margins for the motorcycle company in the first quarter down 600 basis points. Is that a reported number, or is that excluding restructuring costs and tariffs?
No, that's a reported number. So all in GAAP reporting, we would expect Q1 operating margin at the motor company to be down about 6 percentage points, driven by the incremental tariffs in particular, but the shipments being down 9 to 17%, as well as unfavorable mix.
Got it. Okay. And then secondly, sort of a broader question. This is, as you mentioned, the 6th quarter in a row where the gap between new and used pricing has gotten better, still wide, but getting better. How much of that gap is due to a lack of what the consumer perceives as meaningful incremental innovation in the motorcycle industry, and how much of that you think is an affordability issue where the average consumer just can't afford a $20,000 vehicle?
With regards to, I don't know what the separation of those two are. I just think that we're in a situation that when a value buyer is looking at a motorcycle, they can receive a 2-year-old Harley Davidson at a very attractive price, and they're willing to forego some of the innovation and the larger engines and some of the features and benefits that we've put on over the last 2 years just because of a very large price gap. And again, we're pleased to start to see that stabilize and start to improve a little bit. But there still is, as we talked about before, there still is a large gap, and value buyers are choosing used motorcycles.
Is there a thought to maybe taking a more drastic approach to pricing, meaning lowering the prices of new bikes to lower that gap and hopefully attract more riders?
Yeah, this is Matt. I would say the approach is rather to continue to invest value of the bikes to use through really smart content. Saw some of that in 2015. That speaks to sort of trade-offs existing sort of pool of buyers. And when you look at everything in more roads, for example, the middle weight platform and the EV portfolio, they're speaking totally different of riders. And so, this is why the strategy is so important and how we framed it with products and broader access, stronger dealers. Just to dimensionalize the middleweight segments that we'll be entering, adventure touring and street fighter. Today, the company's heavyweight coverage in major global markets is about 43%. Those are the 43% of the heavyweight segments we participate in with touring and cruiser. When we add street fighter and adventure touring to our mix, that will more than double, or about double, our coverage as far as the heavyweight segment. And this is the power of us entering those segments, speaking to different pools of existing riders, in addition to the work that we're doing to reach out to new riders and inspire people to ride, primarily, I would say, through the EV portfolio, but everything else we're doing with content as well. So product plays a major role, but hand in hand with broader access, stronger, tell people what we're about and make sure that they're brought in business into the experience, fantastic experience.
Got it. Okay. Thank you, guys.
And your next question comes from the line of Greg Badishkanian with Citi. Please go ahead.
Great. Yeah. Just on the international side, you called out weak consumer confidence in the UK and France. So when did you start to see some weakness in those two markets, and have you seen any stabilization yet?
Yeah. Thanks, Greg. We've been very pleased with our business in Europe. We're picking up market share, growing obviously faster than the market, and it's been very widespread throughout the European countries. It's really just in the fourth quarter that we saw the softness in the UK, and we believe that is a function in part due to Brexit, and then in France due to the Yellow Jacket demonstrations. So hopefully this is something that will pass quickly. Certainly Brexit is still up for decision, but we're keeping a close eye on them. And but other than that, Europe continues to perform very strong, and we've been very pleased with it. And the new Softail motorcycles have been really good sellers all year long.
Great. And also just any maybe some feedback on the customer response to Livewire, that launch. Anything incremental that you're hearing?
Yeah, this is Matt. Thanks for the question. I think it's been a fantastic response. I mentioned in some of my opening comments, but between Milan, then at CES, we had not only Livewire displayed, a couple of the in-development prototypes in our lightweight space, and then most recently last weekend at the Expo, significant positive response outside of, in all three cases, outside of just the motorcycle space. So people are noticing what we're doing. They're looking at Harley Davidson in a different way, and that is very important as part of our strategy to kind of change people's perspectives about how awesome riding can be. The feedback on Livewire has been exceptional, and people haven't even ridden it yet. And for me, that is where the completely different perspective about how thrilling and how easy, exciting motorcycles can be. So when we start getting it in hands, we're confident we'll see even more excitement about Livewire and the rest of the portfolio.
Thank you.
And your next question comes from the line of Garrick Johnson with BMO Capital Markets. Please go ahead.
Hi, good morning. I just wanted to be clear about the tariff impacts that you're excluding from EPS in the quarter and going forward. Is this the gross impact, or is this the net impact after pricing and other actions? Is it just 301 and reciprocal? Does it include 232? And if it does include 232, how do you estimate that? Thank you.
For the quarter, we had about approximately 2018, approximately $26 million of tariffs. Those would be 301 and reciprocal in your terms, Garrick. That does not include metals. We do believe that we experienced higher metals costs. Overall, raw material costs were up $17 million on the year. We believe the primary driver of that was the tariffs, but that's not included in how we're defining our actual tariffs for 2019. 2018 of $26 million. And on a similar basis, we expect that $26 million to be between $100 and $120 million in 2019 when we look at the full year impact of tariffs of our products to the EU, of our shipments to China, and of tariffs that are coming back from international markets, primarily China, into the United States on the incremental tariffs that have been placed on those products.
Okay, so just one more point of clarification. Is that a gross number or are those net numbers after, pricing actions and other actions?
That's the gross amount of incremental tariffs. That's not the total tariffs. That's just the increase, largely of the 25 percentage points in the EU and in China, and in a lot of cases 10 to 25% back in the United States. Not the entire tariff, but it's just the incremental piece, and it does not include any other items in there such as pricing.
Okay, but when you report earnings going forward, you're going to report earnings excluding the total impact of tariffs, not the incrementals. So can we talk about the total gross impact?
The amount of tariffs going forward will be reported, estimated at $100 to $120 million. That is 301 tariffs of our shipments into the EU, into China, which have incremental tariffs of 25 percentage points. We're only reporting the 25 percentage points incremental. And for the tariffs coming back largely from China into the United States, those tariffs range from 10 to 25% increase. We're only going to report that increase. We're reporting it the same way that we reported the $26 million in 2018 to 2019.
Okay, thank you. That's very clear. I'll get back in queue. Thanks.
And your final question comes from the line of David Tamberrino with Goldman Sachs. Please go ahead.
Hey, thank you for taking the question. Just want to understand on the international dealer build-out, it says 56 new dealers. Is that a net increase or were there some that closed? I'm asking because I'm just trying to understand the average inventory levels internationally as full-year retail sales were essentially flat at 95,000 units. International shipments were essentially flat, maybe down a touch at 96,000 units, but you added 56 new dealers. So has there been inventory reduction at the existing international dealers, and is that finished? Thanks.
Yeah, overall, David, the 56 are dealers that we opened internationally. There is a limited number of offsets to that, a handful or two offset to that. Overall, when we look at international inventories, we're up several hundred units on a year-over-year basis, and that would imply that overall inventories are down in the same stores internationally.
Okay, I mean, is that do you feel like you're right-sized for your inventory internationally given what you're seeing from a retail sales perspective, or could that continue in 2019?
We feel good about where the overall inventories are. The fourth quarter was a little bit lower than what we expected on retail sales, and instead of shipping in those and holding on to guidance, we decided not to build the inventory beyond what we had planned, which was up. And in addition to that, we decided to take down primarily our international inventories as well, and that's why we missed our shipment. So very good about where inventories are internationally. And when we look to 2019, we would expect international inventories to be largely flat on a year-over-year basis, despite us adding 25 to 35 new dealerships. And remember, in 6 short quarters, we were going to be adding a plethora of new products under our More Roads banner, and as Matt had mentioned, in adventure touring, street fighters, and the traditional segment, we want to make sure that our dealers are ready to receive those vehicles.
Understood. Thank you.
All right, thanks everyone. There are a few questions remaining in the queue, and I will follow up with each of the analysts we did not have a chance to get to. Due to some of the sound quality challenges, we'll post prepared comments on our website before transcripts are available. The audio and slides for today's call will be available at harleydavidson.com, or for the audio, call 855-859-2056 or 404-537-3406 until February 12th. The ID is 1474809. We appreciate your investment in Harley-Davidson. Have a great day.
And this concludes today's conference call. You may now disconnect.